The biggest mistake in investing isn't what you buy, it's when you sell. Today, I'm going to give you two simple questions that will save you from selling at the worst possible time. Plus, I'll show you the three analysis tools I use every day to make better decisions. Most people lose money because of panic. Think about Meta. It crashed, everyone fled, and then it tripled in value. How do you avoid that trap and know when to hold on? The answer is simpler than you think. The biggest enemy in your portfolio is usually you. It's the emotional decisions, the fear when the market drops, and the euphoria when it rises that cause the most damage. We sell great companies for pennies and buy hype at the peak. Look at Meta's journey. The stock plummeted, and the narrative was all about the failing metaverse. But what was happening with the actual business? It was still a cash-generating machine dominating social media. The fundamentals were solid. Those who sold in a panic turned a temporary paper loss into a permanent, real one. Those who held on, or even bought more, were rewarded. So how do you avoid this? By creating a system. Here are the two questions you must ask yourself before you ever hit the sell button. First, the test of the buyer. Has anything fundamentally changed in the company or in my original investment thesis since I bought it? Did a major competitor emerge? Did their debt explode? Did their core product become obsolete? If the answer is no, and the only thing that changed is the stock price, then you have no business selling. Second, the test of the thesis. If I didn't own this stock today, would I buy it at its current price? This question is powerful. It forces you to treat every day as day one for your portfolio. Each stock must constantly earn its place. If a stock you own has fallen 30%, but you look at it and think, wow, at this price, it's a great deal, then selling would be completely illogical. You'd essentially be getting rid of an asset you believe is undervalued. If this is already helping you think differently about your portfolio, do me a favor and subscribe to the channel so you don't miss future analysis. Answering these questions requires having the right information, and later I'll show you a specific example with a company like General Mills, but first let's talk about the tools I use to get that information. I want to be clear, this is not a paid ad. I use these platforms myself, and I have some links in the description that might get you a discount, but I encourage you to try their free versions first. First up, Simply Wall Street. This platform is perfect for investors who want fantastic portfolio control and visually appealing analysis. Its famous snowflake chart gives you a quick health check of any company. It's brilliant for getting a high-level overview and tracking your investments. However, if you're someone who loves digging into raw financial statements and building your own models from scratch, it might feel a bit limited. Next, Earnings Hub. This is a specialized weapon. Its superpower is speed. It's for active investors who need real-time updates during earnings season. It provides incredibly fast updates to metrics like the PE ratio the moment a company reports its earnings. You also get live transcriptions of earnings calls. It's not a standalone analysis platform, but it's an amazing complement to any other tool. Finally, Investing Pro. In my opinion, this is the best all-around retail platform on the market. It doesn't matter if you're a beginner or an expert. The amount of data, historical information, and analytical tools it offers is immense. It has dozens of valuation models, fair value estimates, and even AI integration to help you process information. If you want one platform, this is it. So, which one should you choose? Using both Simply Wall Street and Investing Pro might be redundant, a luxury rather than a necessity, but Earnings Hub is a fantastic sidekick to either of them. Now, let's apply this. Imagine Google stock drops 20% on some short-term news. You feel the panic, but you stop and ask the questions. Question 1. Has the business changed? Is Google no longer dominating search? No, it's still a giant. Question 2. Would I buy it today? At a 20% discount, for a company like Google, the answer is likely yes. So you hold, and you avoid a costly mistake. And what if you sell for the right reasons? Maybe a company's fundamentals have truly deteriorated. What do you do with the cash? If you're not sure about your next move, don't just let it sit there. Consider short-term bonds as a temporary safe haven while you do your research. Using a tool like Investing Pro, you could identify an alternative like General Mills. You could see that at a price below 10 times its future earnings, it offers a solid dividend and potential for growth. You can project an 11 to 12% annual return over the next decade. That's a rational, system-based decision, not an emotional reaction. Remember, solid companies, especially those in the S&P 500, almost always recover. It's hard to find one that actually goes bankrupt. The key is patience and discipline. Write down your selling criteria before you ever invest a dollar. Don't let fear dictate your financial future. If you found this useful, subscribe to the channel for more practical investment advice. And now, I want to hear from you. What's the biggest selling mistake you've ever made? Let me know in the comments.